We are starting now.
Could we just make that PPT as a full screen slideshow?
I think you should go to enable editing and then.
It's the icon that's right next to the Zoom link, which looks like a inward, sort of almost like a wine glass. At the bottom right hand side of the screen, right next to the negative zoom num.
Anvesha, you can press function F5 key.
Hello. Yes, sir. Sir, I'm sorry. Could you please repeat, sir?
Press the F5 key.
Sandeep?
Function
Sandeep?
5 key. You can press function 5 key.
Can you hear me now? Yeah.
No, it's not the full screen now. Sandeep, can you please do it slide show? The way it's there, like
click on presentation.
note.
Presentation.
Where? Okay. Got it.
Yeah.
Now it's okay.
Yeah.
Yeah,
Welcome.
perfect. Thank you so much.
Perfect.
Kaustubh sir, please let us know when we have to change the slide and accordingly.
Sure, I will do. I'll do that. Yeah.
Okay, thank you so much, sir. Darshan, we've gone live. Getting the signals?
Darshan, we can go for live.
Yeah, sir. We are live on YouTube, sir.
Yeah.
Okay, so we can begin. Thank you so much, sir.
Okay. Good evening, ladies and gentlemen, and welcome to the second lecture on this Global Money Week. We have Mr. Kaustubh Belapurkar. Mr. Kaustubh is currently director at fund research at Morningstar Investment Advisor, and he has been in the field of mutual funds and portfolio investment quite a long time. He has worked in the areas of fund research, portfolio construction, as well as market analysis, investment advisory, and other type of the structured investment solutions. And Kaustubh has been graduated from IIM Calcutta and also from a BTech degree from the Institute of Chemical Technology. He also holds a qualified degree in CFA. We are grateful to Mr. Kaustubh for giving his valuable time. And once again, apologies because of some technical error. We could not able to start at 4 o'clock. So please continue with the session. And once the session is over, like yesterday, Ms. Anvesha will take up the question and answers for set questions. Thank you very much, Mr. Kaustubh. Welcome to the session.
Sure. Thank you so much, sir. And thanks for the opportunity to speak. And hello to all the audience who's listening in live. So what we want to do today is really talk about a topic that's very close to our heart, is in terms of fund selection for portfolio construction, right? So I put it in a very simplistic slide that you would see here is in terms of portfolio construction entails essentially elements of what you would look at in terms of obviously devising what we call the investor asset allocation, which is arrived at by looking at risk return objectives, investment time horizon, other constraints, the investment goals that the investor has in mind. But post that, obviously, you need to get into deciding, asset classes, sub-asset classes, and within that, then which funds to pick, right? So, the chart really puts it down to make it look really simple, but we all know that it is easier said than done. We have 38 fund categories that are, now officially defined by the regulator SEBI. There are almost 1,000 plus funds, and this number continues to grow. So it becomes a very, very sort of muddled space, for investors to think about how do I go about constructing a portfolio, right? Obviously, I think the regulator has done some great work in terms of defining these categories because it becomes, the first job of understanding what each fund within a category is supposed to do has become a lot easier. But even within that, then you would have so many funds with different management styles. How do you really go about constructing an efficient portfolio? I think that's really what we want to focus on today, right? Could we move on to the next slide? Yeah. So when you think about it, right, I said, mutual funds, a plethora of options. If you could just click enter again, a couple of interesting, yeah. So it's like akin to standing in the aisle of a supermarket, right? You want to buy a Tetra Pak of milk, but you don't know what to do because, there are different brands of milk. There are different types of milk. I mean, we're so health conscious nowadays. You have almond milk, soy milk, lactose-free milk, your regular milk, non-fat, all of those that exist. And then there are various brands that you can buy within that, right? So it's akin to standing there in that aisle and trying to pick up a can of milk because, like I said, different fund categories, various funds within that, how do you really pick, right? So what tends to happen is, the herd mentality sort of kicks in with investors, and that's what we've observed, not just in India, but globally, that something that is popular, that people are gravitating towards, tends to be the way an investor would think that, hey, this seems to be good. Can I just, purely invest in that? Can we move to the next slide? Now, this I've just listed down, and we don't need to go through each of them. But like I said, these are the various categories that exist. And obviously, this is categorization that was introduced towards the end of 2017 by SEBI. And there have been a few tweaks to this by some category additions. But you can see there are several categories within, equities, fixed income, money market, hybrid funds, and obviously other instruments that are available. And there are 38 categories in all as today. So it is a challenging task for investors to identify one, which category, and within that, which funds, right? Next slide. So, before we get into a discussion how we pick funds, right? The most common question that we get asked is, do we need diversification? Why can't I just buy, equity in my portfolio? Why can't I just buy, put money into fixed deposits and be happy, right? So the question is that, do we need diversification? Next slide. Yeah, so this is actually a very interesting chart which tells you on the case for diversification, right? When you look at this is the last 10 years calendar returns for various asset classes, and we've put in a mix of them. There's obviously fixed income indices. There are the popular equity indices, but there's also gold, and there's the S&P 500, right? The International Equity Index. The one thing which comes out very clearly is that the same asset class does not perform year in, year out. There will be various sort of, best performers at different points of time, and investors shouldn't get swayed by trying to chase that. Rather, build an asset allocation by investing across asset classes. So we talk about diversification. I think this chart tells you all that diversification is very, very crucial across asset classes. Next slide. Yeah. So now when you think about it from the context of just equities as an investment, right, you will have different sectors come to the fore, exactly like how I said about different asset classes. And investors will tend to, be swayed by thinking, okay, this sector has done really well. Should I be buying that sector today or not, right? I mean, the classic case in point, healthcare, stocks went nowhere for the last couple of years. And 2020, obviously, with the global pandemic, you had this huge surge in healthcare stocks. Obviously, IT stocks did really well. But we know in the past, there have been other segments of the market that have done well. And that's very important to acknowledge that buying a diversified equity fund is actually more suitable for most investors rather than trying to time entry and exit into sectors. You would want to leave the calls to fund managers who are professionally doing this job of money management, who will take underweight, overweight calls on sectors, but they're not going to be flipping sectors, left and right. And, we'll talk about later in the presentation about examples about how you can gauge that as an investor. Next slide. Yeah, all of that said, the crucial part is about fund selection, right? How can you use some of the fund selection techniques that we at Morningstar use and some of the learnings that we've had over, decades of seeing what investors do and what managers do, in kind of using some tips and tricks to actually identify the types of funds you want to have, right? But typically what tends to happen, and again, this is a lot of experience that I've gleaned through the market, interacting with advisors, investors, and fund managers, that these are the things that tend to happen. If you could just quickly press enter so we'll get all the points on the slide. So investors tend to make a lot of, crucial mistakes, and this is not something which happens only in India, it happens globally. Can we just hit enter so we get the points on? Yeah. So one is obviously looking at funds and choosing funds purely on historical short-term returns, right? You pick up a data point and say this fund has done so well over the last 1 year or 2 years. I want to buy into this fund without understanding that why did that fund do what it did so well, and is that fund suitable in your portfolio, right? So the suitability of the fund or the underlying risks of the fund are often not acknowledged, and that is a very important thing to look at. And how do you do that, right? Yeah. Then focusing on short-term volatility rather than looking at long-term returns. So you hold certain funds in your portfolio, and you are just so swayed by that this fund's not doing well, this part of the market's not doing well. Can I move to something that's done well recently, right? And that's the point we want to drive home, that looking at past performance, your rearview mirror driving is probably the most hazardous thing to do for investors when they're trying to make their investments and in picking funds, right? So I think that's a very important. The other important message is also but temporary fund manager performance, right? You will always see at certain points of time different funds will do even within the same category. It's not going to be one consistent fund that's done well over periods of time. There will be various funds that will look more attractive on a past performance basis at different points of time. What is important to understand is, why is that happening? And does that again fit into your sort of portfolio now? Can we just hit enter again and move on to the next slide, actually? Yeah. So this is what we've again observed, and these are very important points that investors tend to display. And it's just not investors; it's pretty much everyone who are susceptible to behavioral biases, right? So you have recency bias, something that's done well recently. You would expect that maybe that's going to continue. Herd mentality, like we spoke about. If everyone's buying it, maybe it makes sense for me to. The other study that we've done globally and hope to repeat that in India soon is the concept of investor returns. And I'll very quickly talk about what that entails. Is that when you look at a fund, and just for example, if the average return of the fund over a 5-year period was say 10%, the average return of investors in that fund is actually lower than that for most funds that you will notice. And why does that happen, right? Because investors will come at different points of time. More often than not, they would come in at points of time when the fund has already done well. And that's why the return gap between what an average investor earned in that fund versus what the fund has actually delivered over the period of time can be quite significant. Globally, the average is about 0.5% to 1.25%. I suspect in India that number could even be larger, but we'll know once we run that study, right? The other few studies that we've done has shown us that recent performance and often very short-term performance drives flows into equity funds or any other funds that exist. But when we did a study of say equity funds, we saw that quartile 1 and quartile 2 funds simply ranked on a 1-year basis, accumulated about 85 to 90% of the flows that you got over the last 5 years. But the more interesting stat is actually over the year of 2020, where one asset manager, we're talking about a country which has about 40 plus asset managers, one asset manager garnered net inflows in the equity funds greater than all the other 39 plus asset managers combined. Now that's a staggering stat. We've never seen that happen, at least in my career, I've never seen that happen. And that is we spoke about polarized markets. I think it's been polarized flows in that sense even from flows or investor behavior. And we'll talk about why that's happened and how we can maybe evaluate such funds, right? Next slide. So just laid out some very simple ground rules, and I won't go through all of them, but just underpin what is needed when you look at constructing portfolios, and we'll get to the fund selection bit of things, right? So one is obviously investors need to clearly articulate investment goals. And how do they do it? They think about their risk return objectives. They think about what's the investing time horizon. And then post that, you actually identify the suitable asset classes, the sub-asset classes that match your investment profile, right? And once all of that is done, you would think about the suitable categories. So earlier we spoke about what are the 38 plus categories. Not every category is going to be suitable for every investor on the street, right? I mean, for instance, a small cap fund entails a very different kind of risk profile as compared to investing, say, in a large cap fund or a fixed income fund, right? So I think that's very important for an investor to acknowledge that what are the categories depending on their own risk objectives, their time horizon. Time horizon is a very important concept that investors need to understand, and then identify the suitable categories. But post that, how do I identify the right funds that would fit into the categories that I've chosen to invest into, right? And then obviously there are portfolio reviews, you rebalance, and then you follow a glide path approach to your investment goals in terms of reducing the more volatile asset class to a more stable, less volatile asset class as you go along your investment journey. Can we move to the next slide? Yeah. So now that begs the question that, if you had to choose funds, how could you do it? We've already started talking about that. Should historical performance be the only criteria to select funds? And the answer is a resounding no. But let's look at a quick study. Next slide, which we conducted globally and in India. Can we have the next slide, please? Yeah, which talks about, what were the underpinnings of the performance of active manager versus the benchmark, for that matter, even of the index versus cash, right? So, I mean, you have two calls. Do you go into equity or do you remain in fixed income, or more sort of stable asset class? And within equity, do you buy active or do you buy passive, right? Now, the study had some astounding results globally, and in India, they were surprisingly no different. And I'll just quickly talk about what the findings were and what that means, right? So we've looked at the last 10 years performance of actively managed funds. And we've broken it down into monthly return series of these funds versus their respective benchmarks. So if I'm looking at a large cap fund, I would traditionally look at a NSE or a BSE top 100 stock index, which would be the suitable benchmark for a large cap fund. And I would then compare the monthly performance of that fund versus the benchmark to see if the fund has relatively outperformed or underperformed, which means if the index was, say, 1% for that month and the fund was 5%, that's a 4% absolute outperformance of the fund. And the same thing, if the index fell -5% and the fund was -1%, that's again an absolute 4% outperformance, relative outperformance for the fund, right? So we took these 120 months, and then for each fund, we kind of put them in a descending order, which means the best months on top and the worst periods of underperformance at the bottom. And then we started knocking off, the best funds. Best months. And what we noticed was that just 8 months out of 120 accounted for all the outperformance of the active fund versus the benchmark, or for that matter, even equity indexes versus cash, which basically means that if you as an investor, for those 8 critical months as we define them in an average fund, weren't invested in the fund or that market or the index, you basically would have underperformed the benchmark or the cash, as the case may be, right? So that's a strong message that just 6.7% of the data series is when the actual outperformance came in. So the point is that you have to be invested to make the returns. You can't be chasing returns and hoping that you would actually kind of catch up. Rather, you need to be invested and stay through a market cycle to enjoy the performance of the market and enjoy the performance of active managers. And if you don't do that, if you start chasing performance, you're actually going to be chasing the tail and always be behind the curve, right? Next slide. Yeah, and this is just very quickly data around that same study, which shows you that it's not just on the broader sort of index, but across categories of funds, be it large cap, mid cap, tax saving, multi-cap funds. You can see most funds on an average have, had very few months that account for the outperformance of the fund versus the benchmark. Next slide. Now I want to show this, I keep talking about flows chase performance. I want to show 2 very classic examples. Next slide, please, which tells us exactly what happens, right? Now, this is an example of a very popular fund, and we'll talk a little later about this fund and its style. But when you look at this strategy, it's done exceedingly well, since the periods of especially 18, 19, and the first half of 20, right? But on a YTD basis, you can see that the fund has started kind of dragging versus the benchmark versus the category average. And if I go back in time, I see 2016 was a very similar period of time when the fund actually underperformed. When you look at the bottom half of the slide is where the flows into this fund have come in. You can see a large part of the flows have actually come in the period of 2019 and 20. And in fact, this fund was the recipient of amongst the largest flows in 2020. Again, this fund got flows equivalent to much higher than the entire category combined, right? Now, the problem with this is, we spoke about the critical months. There's a high likelihood that, the critical months, at least in the recent history, have already passed for this fund. And an investor coming in today, the fund could potentially, just meet the benchmark returns or perhaps even lag it. And we'll talk about why. But investor expectations were set that, look, this fund has done so well. Can it continue to do well, for perpetuity? And that's why the flows probably came in too late. That's something we'll need to discuss, right? Next slide. Now, there's another classic example, and this is a very old example, but it really drives home an important message. That this back in 2007, here was another fund that did exceedingly well and beat the benchmark, the peer group, all of them hollow. And again, you've seen funds, a lot of flows come into that fund, during that, after that performance had already been delivered. And as you can see on the top, the returns of the fund have really significantly dropped sharply after that. And investors' experience has been completely sullied because they thought this fund could, potentially provide this outperformance for perpetuity, but the truth was actually very different. And we will talk about what was the engine behind our thought process as to why probably it was not suitable for most investors, right? Next slide. So now when we think about how should you actually be using mutual fund selection techniques to pick funds, right? So one, the most common analysis, like I said, is performance, right? But can you pad that up by using quantitative risk frameworks, be it risk-adjusted returns, and there are various types that are out there, your Sharpe ratios, your Sortino's, your information, and so on and so forth. And Morningstar also has an interesting ratio, which I will quickly talk about in the subsequent slides. But we think quantitative analysis is probably only a starting point to making fund selection, right? Because what that fund has done in the past is the past. What you need to assess is that what worked for it in the past, are the elements, are the ingredients still in place for it to continue to do so over a long-term consistent basis? And how can you evaluate that? So that's where the qualitative assessment part becomes very important. The first thing is obviously evaluating who's the fund manager, the people, the fund manager, his team, do they continue to manage the fund? And secondly, the process, right? That what is the investment style? What is the process? Is it being followed consistently over a period of time or not? So, it was skill rather than just being at the right place at the right time, right? So you can do that by looking at performance attribution of funds, understanding what have been the drivers of alpha for that strategy. And then once you do all of this, you need to think about diversification. You need to think about how do you build an all-weather portfolio, and you can do that very nicely by actually bringing different fund manager styles through gauging those styles and actually creating diversification through varying investor style, fund manager styles. Can we move to the next slide? Yeah, and this is just a very quick understanding of the I was talking about our proprietary Morningstar data point, which is on risk-adjusted returns. Now, like I said, there are many commonly used risk adjustment returns, and we've kind of done a tweak on that, which is thinking like an investor, right? So now when you think about the standard concept of volatility or deviation, you always think about it from the context of that, okay, as a mathematical formula, there's the downside deviations and the upside deviations, and both are given equal weightages when you think about it as a normal, and that's what Sharpe ratio does, right? Now, what the Morningstar risk-adjusted returns essentially do is think like what an investor would think, because an investor doesn't mind upside deviations or positive surprises, but they hate downside deviations, right? The smallest amount of negative surprise can upset investors, and the larger the negative surprise gets, it's going to make them even more they're thinking about what's happening with that fund, right? Now, if that's the case, you would want funds that are less volatile, and especially on the downside, they don't fall as much as the benchmark on a relative context, right? And that's exactly what this risk adjustment does. And that is the basis of the Morningstar star ratings, where we look at long-term risk-adjusted returns of funds and compare them to the peer group. And we think that's a good way of starting a shortlisting process when you want to see the funds that have consistently done well over a period of time, right? But when you can we go to the next slide? When you think about it from the qualitative assessment, as an investor on the street, here are a few questions that you should be looking at and trying to understand. And it's not hard to get it because luckily for in our country, the disclosures which have been set by the regulator are so transparent, so great. We actually ranked amongst the best countries in terms of disclosures. You can get information on. You get monthly portfolio disclosures, in fact, now fortnightly for fixed income funds. You get to know exactly who the fund manager is, what is his experience, who are the other people in the team. All of this is available for investors to go through and actually make decisions, right? So here are some of the things that you should be thinking about when you're trying to assess funds for greater information about do they make sense in your portfolio or not, right? Who's the fund manager? How long has she or he been managing the strategy? What's the experience? Is it relevant to the fund that's being managed? Who are the other members of the team? Have they, has this team been seen a lot of turnover or have they been steady? Because all of this really matters. There have been enough and more studies that have been done that shows that a team that follows a consistent sort of framework working together actually does deliver better returns, right? Then the second bit is the process in trying to understand what is the investing style of the fund. And we'll talk about in the next subsequent slides what, how can you identify the slide, right? But the important point is that what is the style and has it been consistently followed over a period of time? I mean, the proof of the pudding, performance should be a result of a consistent team, a consistent process, rather than just being in the right place at the right time, right? So then you realize the method to the madness of the performance being delivered, rather than someone who was just there in the market cycle that worked for them, right? So that's what is very important, and you can look at fact sheets which will easily tell you that have they over a period of time been kind of largely sticking to a style. Style boxes which we publish, a lot of other people publish. You can gauge what the style of the fund is, and when you look at fixed income funds, again there are style boxes for fixed income funds which will allow you to decipher are there any inherent risks in the fund that you're buying, be it interest rate risk or credit risk, right? And I think it's very important for investors to understand this and look to evaluate that. I mean, everyone has to, it's finally your money, you have to do homework on your own. Obviously, if you don't understand it, do be guided by an investor, but eventually by an advisor, but do some homework on your own. I think that's a very important takeaway, for all of us on the session. Can we move to the next slide? Yeah. So I will now quickly spend some time talking about, the equity fund selection and the fixed income fund selection. I know we've already kind of, been starting off late, but I want to spend some time because these are important messages that we want to send across. So one is obviously, like I said, the style box of a fund, right? You can identify one sort of style, and that's very, very well documented, which is the capitalization of the size factor, which is large, mid, and small cap stocks. And in fact, SEBI is very nicely bucketed funds within these categories, so it becomes easy to identify that. But the other element, which is the style factor in terms of is he largely a growth manager, is he a value bank manager, or are they running a growth at a reasonable price, buying more sort of GARP led stocks? I think that is something which is important, and the style box allows you to get a sense of where that fund is currently, but you can even go back in history and try to see if it's been consistently run, right? Next slide. Yeah, sorry, my bad. I don't answer, but this is the style box that I was talking about, which tells you where the fund lies. Next slide, please. Yeah, so let's look at a few case studies and try to understand through these, can we see if there is a consistent style being followed? Identify the style for starters, and is there a consistent style that's being followed, which tells us that it was skill and not luck, right? Next slide, please. Yeah, now this is. You remember this chart? We showed this, the fund back in 2007 that it did exceedingly well. Beat the benchmark hollow, beat the peer group hollow. Saw a lot of fund flows come in, but it did drag. After that, it saw a pretty sharp crash, and it couldn't recover from there. Right? Next slide, we'll try to look at what the historical data tells us. Right now, without even getting into the information about, we just look at the charts, and they look like very busy charts. Right, the top chart tells you what the exposure to the capitalization and style of the fund was, and the bottom chart tells you what the sector allocations for that fund was over a period of time building up to 2007 and beyond. Right now, without even focusing on what style or what types you bought, the first thing to acknowledge is that you can see the colors of that graph changing throughout the period of time, which tells you that there is no consistent sort of style. It was more sort of momentum based, chasing the market. Now in 2007, the fund was allocated to the industrial segment, which did exceedingly well, and they were severely over allocated to that. There was a lot of sector rotation that was happening. It worked in 2007 for them, but obviously post that it didn't work, right? So is this a repeatable investment process? I mean, the answer would be most likely no, right? I mean, okay, the manager did get a stock picking right, a sector call right in 2007, but common intuition would tell you that it's very hard to time these sector rotations year in, year out, because we saw that you cannot do that when we've seen the sector rotation chart for the last 10 calendar years, right? So here is something, if you would look at this fund at that point of time before investing, you would realize that there has been a lot of sector rotation, stock rotation, and maybe that's not something I want to get into, right? Next slide. Now, there's another interesting case study in terms of the funds performing well, but are there any other risks lurking, right? Next slide, please. Yeah, this is another very popular fund that was being run by an excellent fund manager. But the problem that was there, and which was that it was a very, very centric process to Kenneth, in fact, who was running that strategy at that point of time. And the moment he left the organization, they had good managers at the helm, managing the other funds. But this process was so centric to one person that it became a challenge for the people who took on the mantle to continue to run that strategy in the same fashion. And that was the challenge, right? So the key man risk. Now, I think investors can also look to gauge when they're looking at funds from a perspective that, I've identified these funds. You need to look at, we spoke about the people. Has there been consistency in the team? Is the same manager continuing to manage the strategy? And, does the rest of the team, through the fund documents, which you can easily ascertain, are they continuing to do so, right? And clearly that was a challenge that existed for anyone who came in 2015 when the fund managers themselves had changed. There are cases where the process is probably more institutionalized, and I'm very happy to see that's happening broadly with most asset managers now, that even if a fund manager leaves, the process doesn't get hurt because it's not purely driven by that by him or her. It is a more team-driven approach with the analysts feeding in ideas. But just the nature of this process at that point of time was largely underpinning the manager's style, and that was a challenge, right? Next slide. Yeah. Now another interesting case study, and a very, very I think pertinent case study is, a good manager, good process, but the recent performance doesn't stack up, right? Next slide. Now, this is, a fund that's been around for the longest time, a great manager, Prashant Jain, who's been managing the strategy for a very long time. It is a large cap fund. Now, the interesting bit to note is that it has gone through a period of relative underperformance, right? And we'll try to evaluate that, does the process still hold, or have things gone wrong, right? But when you look at the year 2020, this fund has obviously significantly underperformed both the benchmark and the peer group, and pretty significantly, right? 9 to 10% underperformance is pretty stark. And you can see the same thing playing out in the bottom half of the chart, where the net flows from the fund. Investors have started to redeem in the year 2020 because they lost hope, thinking that something's gone wrong with this fund. We want to exit, right? But when you look at the YTD returns for this fund, it suddenly seems to be coming back. So is that something that the fund managers changed or not? Let's look at it in the next slide. Yeah, the same, right? We look at the style analysis of this fund, and the fund style box will tell you the same thing. I'll focus on the top half of the chart, which is the bright blue and the light blue parts, which we call the growth, the value and the blend part of the portfolio. You can clearly see that this portfolio has largely always, on a relative context at least, maintain a pretty significant allocation towards the value and blend portion of the portfolio. And we look at another example, which is pure growth. But as you can see here, his style has been always focused towards sort of the more counter-cyclical space, the value segment of the market, which he's, the fund's been running for a consistent period of time. Now, back in 2020, especially, or in fact, even leading up to 2018 and 19, when the fund underperformed, we all know that the growth and quality segment of the market did exceedingly well, whereas the value segments were laggards. But over the last couple of quarters, which is being spoken about quite widely, you see the cyclicals, the PSUs, the metals having come back in a way, right? And so obviously the proof of the pudding is that the process remained consistent despite the sheer underperformance that was, which was being witnessed in the fund at that point of time, right? So the manager, a good manager, stuck to his process. Unfortunately, there was a section of investors who probably lost hope, thinking that, look, this fund's not for me, and they got out. But, we've identified that the process is being consistent, and obviously, what's the style? A more value bend style, right? The next slide. Yeah. Now, this is something that we do internally, but I'm just sharing it for the understanding of the audience. This is a performance attribution chart by style, which tells you, when I look at the left part of it, which is telling you that here's a manager over the last 3 years has maintained an overweight to large value, as you can see from the relative weights, the bright blue bar for large value, and certain amount of overweight versus the benchmark on mid value. So clearly playing an overweight stance on the value segment, not just now, but consistently. And when you look at the allocation effect, which tells you that how is that done relative to the benchmark over the last 3 years, like I said, value has underperformed, and you can see the red bars for that fund. So essentially, we know the fund's underperformed, but the reasons are explainable because he was operating in a part of the market that didn't do well, right? So if I go back to the earlier slides, we can ascertain that different sectors, different cycles, market cycles will work at different points of time. And here's a manager who stuck to his guns despite that not working for him, right? Next slide. Yeah. Now, this is obviously a very short-term performance, but again, just want to drive home the point. This is the year-to-date returns or the attribution from that fund. Again, obviously large value, large sort of mid-value where he's been operating overweight stances. He continues to do that. And you can see by the virtue of being overweight large value, and that's really helped him. And overall, his stock selection, even on the blend side, where obviously he does operate to some extent, have kind of obviously there's a very short time frame, so it looks a little lopsided. But the point being that by sticking to his conviction, sticking to his style, not chasing the market, that is eventually working in his favor. Okay, so like we established, a value style manager has consistently followed the process. And if I'm an investor looking to buy a value style fund in my portfolio, that's maybe one of the funds I would consider. So I wouldn't be shying away because that fund underperformed in the year 2020. I would actually be thinking that it's an opportunity to buy in my portfolio at any point of time, right? Next slide. Now let's look at another case study, a fund that we showed earlier in the slide that has done exceedingly well, has gotten a lot of money. Was it skill or was it luck for the manager, right? Next slide. So this again is the Axis Blue Chip Fund, which, like we said, has done really well in the years of 2018, 19, 20. And you can see the flows have come towards the fag end of this period, kind of chasing the performance of the fund, right? Now, if I just take it back a little bit in time into 2016, this fund significantly underperformed the peer group and the benchmark. And then, it started paying off, right? So let's go on to the next slide and see what happened with this fund, right? So now if you look at this chart, it's again a similar reading where the fund is actually on the opposite side. He's largely a growth and quality manager. He does take some exposure to sort of, companies that are probably in that bucket between blend and growth, but largely the focus is towards growth quality companies. And he's also professed very clearly that, look, I don't worry so much about valuations as long as I'm convinced about the quality of the growth, the quality of the management, and I will continue to stick with that. And they've done that, right? So we spoke about the period of 2016 when the fund underperformed, because that was a part of the market again where the cyclicals, metals worked. Again, kudos to the manager. He didn't get into the value segment, right? He didn't try to change his style. He stuck to his large growth style. And when growth came back in favor in 2018, 19, first half of 20, you can see he's reaped the benefits of it. But again, the point why I'm saying is this, that when investors look at performance and think about this fund, they're like, wow, this fund has beaten the benchmark, the peer group by a significant margin. What they perhaps don't acknowledge is that there is a reason why that happened, right? So if they wanted to invest in this fund, they should have probably been there at the start. And even if you're coming in today, come in with the understanding that the fund could easily lag or kind of be on an average performance for a period of time if value comes into play for a prolonged period of time, right? Because this manager is not going to change that style, and we appreciate that, we acknowledge that. But investors should come with that clear expectation mindset that I'm buying this from the concept of that I want a growth manager, and we think he's done a good job of managing it with a growth style. Even if growth underperforms over the next year or 2, 3, we don't know when cycles turn, I will continue to hold it. But what is important is the next bit, right? So can we move to the next slide? Yeah, actually, let's skip the slide and let's just move on to the next slide. Yeah, it's the same attribution that we spoke about. You can see he's played large growth, and that's really paid the outperformance for the manager over a period of time. But when you go to the next slide, we'll see that the underperformance, so if you can see the next slide, he's continued to stay large growth over the last 1 year, but obviously by operating in that segment, he's suffered because growth has kind of underperformed the value segment, especially over the last 6 months, and then showing up over the 1 year performance now. So it doesn't mean that the strategy has gone bad overnight, right? Because like I said, no one can predict when the market cycle is going to turn, which sector is going to come into favor. But if you stick to a particular mandate, a fund manager sticks to that mandate, and you as an investor can buy funds with different styles. So we saw the HDFC 100, a more value bias manager. We see the Axis Blue Chip, which is a more growth style manager. If I buy both these funds in my portfolio, it actually makes an interesting case for diversification, right? Because at one point of time, at any point of time, there would be one style that would be in favor and working for me, rather than trying to buy only all growth stocks. And coming into the party a little late where, perhaps the growth rally has largely played out and the market cycle looks to be turning, that could be a challenge, right? So if you can actually diversify your portfolios, and how do you do that? The next few slides will tell us that. Yeah. Next slide. So how do you blend fund manager style? Right? So I've just taken examples of 3 popular large cap funds, and this is a very simple style box analysis which you can see on our website. You can see on several other websites, which will tell you what the composition of a portfolio is. Obviously, they're all large cap funds, so you would see most of the allocation is towards the large cap capitalization stocks. But the interesting bit is the style, right? You can see, for instance, the Mirae India large cap is a more growth at a reasonable price manager with a large part of the allocation towards blend. He does buy a few value stocks, and obviously, straddles both value and growth, but largely he's kind of concentrated. He is conscious of valuations, will cut exposures if valuations become expensive. The second bit, obviously, the Axis Blue Chip, like we spoke about. Clearly, he is a more growth style manager. You can see that, and we've already established that through the previous slides. And the same thing with the HCFC Top 100, where you can see he's got a much larger value and blend exposures compared. His exposure to growth is much lower than the others when you look at it from the context of that. So the important thing is that here are funds with varying styles of management. So if you add these on to your portfolio, you can actually get what we call an all-weather equity large cap portfolio in that sense. I mean, again, just to be clear, these are not necessarily recommendations, but these are being used as examples of what you can do to identify fund manager styles, identify if they've been run significantly consistently, and that will really help you make a decision in choosing funds, and also importantly sticking with funds in case a fund starts underperforming for a short period of time, as it's happened with all these funds that we would we're talking about here. Can you move on to the next slide? Yeah, and this is just another way of looking at the same data, which tells you, when a lot of investors come and ask us that, I want to buy another fund in my portfolio, which is the one I should buy. Now, this is a very simple chart which tells you what is the common holding portfolio between various funds, right? So this is an exercise any investor can do, that looking at, if I'm trying to add another fund for my portfolio, is that fund actually adding value from the context of diversification? Because if you're buying a fund which has 2/3 of the portfolio similar to another fund that you're already holding in your fund, then in your portfolio, then there's really no diversification happening, right? So I think that's a very important thing that investors need to look at, that you need to diversify scientifically and not just chase performance and buy funds that are the flavor of the season. Now, what we'll do is, so we've spoken about equity. I will spend some time talking about the fixed income. If we go to the next slide, is also evaluating a fixed income, and obviously it's been in the news over the last couple of years, and we've had a lot of events and volatility in the fixed income markets. So I think it's important, again, just to kind of set the ground rules, what investors should be thinking and looking at, right? So we've obviously had a very good sort of definition of categories that SEBI has defined, from duration buckets, which defines your interest rate risk of funds, and there have been specified credit risk buckets that are there. But the one thing that is kind of which is open is in terms of duration, the credit exposures that funds can take within various duration buckets, right? And we see that there are funds that do take on an additional level of credit exposure within their funds, while certain portfolios run pure, say, AAA government bond portfolios, right? So how do you, as an investor, make that assessment? I think the fixed income style box is a very easy way to start assessing that. Now, when I look at the style box, it tells me 2 things. One is the duration exposure, which is on the x-axis, which is is it limited, is it moderate, or is it high? And the y-axis tells you that how's the credit exposure or the credit quality. Is it high? Is it medium? Or is it low? So, for instance, in this case, when I look at this fund has limited exposure to interest rate risk. The duration is in a narrow band, but the credit risk seems to be on the elevated side because it is probably holding a lot of lower rated instruments in it, and that's a very easy way of assessing that as an investor, right? You can go back into history. Next slide, please, and do the same analysis for a fund. Now, this is obviously something that we run internally, but you can do that as an investor by looking at fund fact sheets, which will tell you what has been the broad exposure to the various credit buckets. And I think that's a very important exercise we should do as investors, trying to assess that, if the performance of a fund was such, was it because it was taking on certain elements of risk? It could be interest rate risk or credit risk, and that's why the performance has come in. It's important to evaluate that, understand the risk, and if you're comfortable with it, sure, go ahead. But it's, you have to acknowledge those risks and not just purely look at performance and color, right? So the credit breakup historically can tell you how consistently a fund has been managed. You could do the same thing for, next slide, please. understanding the maturity profile or the duration exposure of funds. Now, this is obviously at a point of time, but on the next slide, you can see that. Can we go to the next slide? Yeah. Yeah. Sorry, can we just go to the last slide? I think the next slide, please. No, the next slide. Okay, my bad. I think I've left that out, but there's another chart that I wanted to show the audience is in terms of the modified duration of funds. You can see the same way we saw the credit history. We can see the duration management of the fund and see if there's additional amount of interest rate risk that exists in the portfolio. You can easily ascertain that. If you can go to the previous slide, you can also compare funds for what is the exposure to various credit buckets, right? Like I said, within the categories that the regulator has created, there will still be funds which will have subtle nuances where maybe a certain fund, like you can see here, fund 2 buys purely AAA rated credits, whereas fund A will go down the credit curve. As long as you, as an investor, understand those risks that are entailed and you think that is something the manager has been consistently applying well, that's a call that you can take. But I think that is a very important thing to acknowledge, that you need to be aware and cognizant of these risks that come in with something like fixed income investing decisions when you're selecting funds for your portfolio. So I know I've grossly run over time, and we've had technical issues at my end. So my apologies for that. But I think we can open it up for Q&A. And thank you so much for being a patient audience.
So thank you so much for this wonderful presentation. I'll be honest, I have been closely following most of your discussion forums on Morningstar and the Mutual Fund Show. And ever since I started investing in mutual fund, you have been one of those gurus whose what do you say, the thoughts and everything I've been following to gradually begin with mutual fund investing, and then gradually begin with the large cap and whatever these days I'm building my portfolio on. So I'm sure a lot of people have a lot of questions. We have a question that has come up from YouTube, where a person asks about flexi cap and hybrid investment. So could you please elaborate on flexi cap and the hybrid investment options available?
Sure. And that's, I think that's a very important question to address. So, in the recent guidance, obviously there was a new category that is created, which is called the flexi cap category, by the regulator. And let's just talk about what a flexi cap fund will entail. So essentially, it is a category which allows funds to invest across the capitalization curve. So we spoke about large cap stocks, mid cap stocks, and small cap stocks. The fund managers has the sort of the leeway to decide what are the allocations to each of these categories, and there are no limits set for that in that sense, right? Like you have other categories like large cap, which mandates that 80% of the portfolio should be invested into large cap, the top 100 stocks, or mid and small caps, where at least 65% should be into a mid cap or a small cap, as the case may be. The flexi cap allows complete freedom for a manager to choose where they want to invest, depending where they think is probably the sort of the best capitalization curve to work with. Obviously, one important thing to acknowledge is that, and which is actually a good thing, is that a lot of fund managers will tend to hold large cap bias portfolios in this space. And the reason for that is because, when you think about a flexi cap fund, it is kind of a one solution shop that, either you can buy a flexi cap fund or you could buy a large cap, mid cap, small cap. We spoke about asset allocation that help. A flexi cap could help you kind of, cross the realms of all of these three categories and probably have just one fund, right? Now, most investors, on the average investor on the street, would prefer having a large cap bias fund, purely because that's how we would construct portfolios, with the large cap bias. And that's where, flexi cap becomes a very important category, where, instead of buying a pure large cap, pure mid cap, pure small cap, maybe you can play the same thing through a flexi cap fund, right? Now, hybrid fund actually takes it one level above. And hybrid fund, again, there are various types of hybrid funds, but the basic concept is that we spoke about the overall asset allocation. So how much in fixed income, how much in equity, and if there are any other asset classes that you can invest into. The hybrid fund lets you do that through one fund route, right? So if you buy, and I'll talk about a couple of the types that are there, but for instance, an aggressive allocation, a regressive hybrid fund will essentially, as per the mandate, buy 65 to 80% into equity. So they have to move into that narrow band. And that's been defined so that investors come with a clear expectation that this fund at any point of time will have at least a 65% exposure, going up to 80%. And so if you're an investor who's looking to invest in the equities, probably a first-time investor, not sure about asset allocation, hybrid funds become a great way of doing it, right? The other end of the spectrum there's a conservative hybrid, which tells you that look, you can buy about 15 to 25% into equities, nothing more than that. So this is for the more conservative investors who want to take some equity exposure, but don't want a very excessive exposure. A conservative hybrid sort of fund would be great, right? And there are other various categories, be it a multi-asset fund, which could buy things like gold or other assets, or what the new sort of dynamic asset allocation funds, which lets you change equity exposures. But I think that the basic sort of kinds of hybrid funds are pretty useful for investors if you don't want to get into asset allocation mode on your own.
Thank you, sir. Sir, do mutual funds that drift more have poor governance structure? What is your take on this?
Yeah, so I think there are a couple of things you need to think about from the governance and the drift bit. So one is obviously, are there, if the drift is consistently happening. So one is, if you see a drift in the portfolio happening, frequently, then that is a cause. Either there are frequent fund manager changes, or there is not adequate risk management, or the investment processes are not set, right? But if there is a one-off change that happens, which could just purely be because of the element of that they are reshaping the strategy, that's fine. But if you consistently see changes happening over periods of time, then that does raise a lot of questions, and that's something you would want to assess. But governance does go well and beyond that. For instance, there are a lot of things that you would want to think about. Obviously, risk management is a very important thing, but there are other ways of think about it. That how do you compensate managers for performance? Are you incentivizing them to chase returns over the short term, or are you linking their variable pay structures? And this is a very important thing that is tracked globally. That how are fund manager compensations arrived at from the perspective of their performance versus the sort of the peer group and the benchmark? Is it linked to 1 year performance, or is it linked to more long-term performance? Because say, for instance, I'm an equity manager. I don't want to be chasing 1 year performance, right? I mean, an investor does not come with a 1 year horizon. He comes with a 5, 7, 10 year horizon. So the skin in the game for the manager in terms of his variable sort of pay should be linked to the long-term performance of the fund. He should be told that it doesn't matter if you underperform over the short term. That's fine, because we're not looking to reward you for short-term performance. You're looking for long-term performance. So these are the various elements that you look at. But yes, a consistent process, a good risk management framework is very important when you look at the governance aspect of things.
Sir, in your opinion, what is the mathematical method that we can use to measure the style drift?
So I think, obviously there are numbers that even we publish in terms of the style consistency metric, which will tell you that irrespective of the style that's being followed, has that been kind of consistently followed? There is no pure, I would say there's no one number that you can look at, and a lot of this can be subjective in that sense. Obviously, like I said, the consistency metric could be one, but that may or may not tell you the entire story. What you need to do is actually qualitatively evaluate a lot of these things in terms of the style. That is it broadly being, because it's never going to be the case that because what I think of as value may not necessarily always be value definition for the manager, and so on and so forth for growth, right? I mean, there are different ways of defining it. But if the broader number mandate looks fine, the performance attribution tells you that they are delivering the returns through those aspects or the areas that they're focusing on. So it tells you, gives you confidence that what they're saying, what they're doing, and what the final outcome is pretty much in sync, right? Broadly in sync is what I would say, because obviously you'll never get 10% right.
Thank you, sir. Sir, so the Morningstar have the grades. So are they only for the US, or can we use them as government ratings for Indian mutual funds also? The Morningstar grades.
Okay, so the grades actually are something which we do not do anymore. If you're talking about the stewardship grades, that's something which has been discontinued now. But what we do, and let me just quickly talk about it, we have various rating mechanisms, and we do that in India too. One of the rating mechanisms, which we call the analyst ratings for funds, incorporates what we call the parent pillar, which is basically the asset manager. And we look at a lot of these factors in terms of, be it, like I said, the governance, the risk management structures, the stewardship code in terms of, is
Yes, sir.
the asset manager
stewardship
working?
grades.
Yeah.
Yes,
Yeah,
sir.
yeah. So the grades don't exist anymore, but the parent pillar kind of encapsulates a lot of the elements of the stewardship pillar, and we do have that for a certain. Some of the funds that we cover within India too.
So now we have a question from somebody who wants to start an early investing at the age of 20s. He
Mhm.
wants to know whether it's fine to be overly aggressive at this age, especially, sir, if somebody who comes out, who's fresh and raw right after college wants to invest in something. What sort of investment do you suggest for somebody who has maybe a yearly income of, let's say, around 5 to 6 lakhs? So what percentage of the monthly income should he or she invest in, and what sort of investment, what sort of mutual funds will be the best at this age?
Sure. So, firstly, I'm glad to hear someone who's 20 and asking this question, because I think most of the money is made through being invested in the markets over long periods of time. And I think that is a very important message to all the young listeners, that start early, start systematically, right? So one is, it's great that you're thinking of investing at 20, but the first question that he or she needs to ask, how long do I want to invest, and do I have any short-term goals, right? So we always link investments to goals. For instance, if you're 20, you might want to be thinking about, say, buying a car, or maybe start putting down a down payment for a house 5-10 years down the line. Perhaps, get married in 10 years, so you want to build a corpus. So you have to think about all these investing goals, because not every goal will be a long-term goal, right? There will be short-term goals, and there will be long-term goals like retirement. So that's what we decide. So, if the person who's asking this question has one goal, which is retirement, and I would probably save separate. So you could do that by creating separate goals and creating separate portfolios for that. That's one way of doing it. So let's talk specifically about the portfolio only, which is a long-term, say, 30-year portfolio. So first, I would say that be as aggressive with your saving. And this is a very beautiful formula someone told me, and it's so simple but so hard hitting. Is that when we think about investing, right, we always think of income minus expenses is equal to saving, and that's what we invest, right? How about we flip that equation and we say income minus saving is equal to expenses? So first you fix that you want to save this much on a monthly basis, and only then decide how much you can spend. Because what happens is, you're getting this income, you're very happy, and you want to just spend it all, and then think about, okay, this much is left, let me invest. So let's flip that equation to start with. I would say at least 30 to 35% of your monthly salary is a bare minimum that you should be looking to save. And since obviously, we spoke about a goal of 30 years away, you can be pretty aggressive, right? You can, if you're not going to look to use this money at all, you can go 90, I would say about 90% in equities, keep some liquidity aside, because if there are any exigencies, you would always want to build sort of corpus towards any medical or any other emergencies that come about. COVID's taught all of us that. But you can be aggressive. You can get a 90% equity exposure. You can build that up through, I would still say large caps would be a larger part of it, but you can definitely add sort of mid and small caps, significant chunks to your portfolio. And basically just stay the course, keep investing. We talk about SIPs. Drawing a monthly salary, that is the best way to continue to save month on month, because an SIP ensures that you will keep that money aside in your bank to fund your SIP and not spend that away. So that's one way of fixing your saving. So I would say just keep that goal, and keep building that corpus, and you'll be surprised how that money grows if you start investing early. But just, for the more mature audience who probably closer to their goals, the other important thing to keep in mind, and I've kind of alluded to that earlier in my presentation, is the very important concept of glide path. And, you think about equity is a great long-term investing scenario. But imagine if you were an investor in the month of March 2010 and said, look, I have a 10-year horizon, so let me put all my money in equity. You did that. It did fantastically well for you. But come March 2020, when the crash of the COVID crisis happened, your portfolios would have fallen anywhere between 30, 40, 50%, right? Now that is a challenge, because if you had a goal that you had to meet in the month of March of 2020, you would actually be in, you would have a pretty big shortfall. you thought equity is a great 10-year asset class, but you had this significant event risk that happened, right? So the glide path, what it does is it moves money from the more volatile asset class, which is equity, as time goes on. As you come closer to your investing goal, it'll start moving money to fixed income or the less volatile asset classes. So that's something I would urge people to think about, because we all talk about asset allocation, but the glide path concept is not spoken about often. And I think that is a very crucial thing to acknowledge and understand.
Thank you, sir. Sir, one of our attendees wants to know, how effective is it to invest in cryptocurrency?
Okay, I'll be honest, I'm probably completely unaware of cryptocurrency. So I'm probably not the best place to answer that. I'll be frank, I have no understanding or knowledge of this. So I'm going to pass on that question.
Sure, sir. So there are a lot of questions that comes in, but we've already overshot the time. But what I can request my audience is to put up the questionnaires on our, the recording of this session will be put up on our website, PI, Platform for Investors Education. And people can pose their questions there, and we can definitely get back to them accordingly. Sir.
Absolutely.
And thank you so much, sir, for the wonderful webinar, sir. I've been looking forward to a webinar from your end for quite some time now. I'm very happy to have this. And thank you for accepting our invitation at such a short notice, sir. We look forward to having many more webinars, and especially after COVID is over, we would definitely want you to be there in IIM Bangalore and enlighten us more about mutual funds and investments and all these rigorous topics that are the contemporary topics, especially.
Absolutely. My pleasure. And thank you so much for the opportunity. And thanks to all the listeners. It's been a pleasure. Thank you.
Thank you so much, sir. Thank you to all the attendees. Thank you.